Welcome back to the deep dive. We are diving into, well, a really crucial moment in modern financial history, a pivot point for one of the world's most powerful institutions.
That's right.
Today, we are setting the dial back to 2011. The financial crisis of 2008 is still a very recent, painful memory, and the entire regulatory foundation beneath Wall Street is being rebuilt piece by agonizing piece.
Yeah, and our source material today is the annual letter from Morgan Stanley President and CEO James P. Gorman addressing shareholders in April 2011. This isn't just, a corporate update. It's really a structural manifesto.
Right.
What's fascinating here is getting a real-time snapshot of how they plan to prevent a recurrence of the crisis by, well, entirely redefining their business model while somehow simultaneously driving growth in a market just defined by uncertainty.
So our mission here is to quickly extract the core strategy, the survival blueprint, really, and pull out those aha moments of institutional adaptation. We're going straight to the source. Okay, let's unpack this. What does a global institution tell its shareholders when the entire regulatory landscape is shifting beneath their feet?
Well, they seem to lead with some stark honesty, recognizing the context of extraordinary change since 2008.
Okay.
The letter explicitly calls out unprecedented market turmoil, industry consolidation, and sweeping regulatory shifts. But here's the key bit, and it's a moment of, I think, historical transparency. The firm explicitly states that the U.S. government support provided in 2008 and 2009 was essential to preventing the total collapse of the financial system.
Wow.
Every firm, including theirs, benefited. They're quite clear on that.
That acknowledgement is huge. It sort of implies a strategic, maybe even a moral commitment to playing a constructive role in regulatory reform, doesn't it?
It seems so. They couldn't just stand on the sidelines. They mentioned Dodd-Frank, and they mentioned the progress on Basel III capital and liquidity standards.
So was the mere existence of these rules helpful at that point, even if they weren't fully baked yet?
It provided much-needed clarity on direction, but not yet certainty. And this is where Morgan Stanley offers a critical, I think, thoughtful plea, what do you call the regulatory paradox.
Right.
While they noted the market desperately needs certainty, they argued that it is more important that rulemaking gets done right than that it simply gets done quickly.
That is a very pointed statement, arguing for long-term precision over, well, short-term relief. But didn't that delay risk allowing for uncertainty or maybe even regulatory arbitrage globally?
It definitely opened that risk, yeah. But their rationale was based on the fundamental nature of the business itself. They emphasized that financial markets are global, interconnected. So the regulatory regime must be global and synchronized as well.
Because risk crosses borders.
Exactly. Because, as they put it, risk cannot be defined or contained by geographic borders. They believed that if they had rushed the rules, the system would have remained flawed. Only a synchronized global approach could genuinely lead to a safer, more secure sector.
Okay, so if that was the external plea, how did they, walk the walk internally? They couldn't just wait for synchronized global rules. They had to structurally change the business immediately.
Right.
And here's where it gets really interesting. What were the specific operational pivots they made since the crisis to manage risk and fundamentally change how the firm made money?
The structural changes were enormous, really designed to shift the risk profile away from that volatile proprietary side and more toward the stable client flow side.
Okay.
They outlined 4 concrete actions. First, strengthening their investment banking franchise. Second, building out client flow businesses in sales and trading, which means trading for clients, not the firm's own book.
Right, not taking their own risks.
Precisely. Third, refocusing asset management around historic institutional strengths.
And the fourth point, the one that feels like the most culturally and financially seismic pivot, was the closure of their proprietary trading groups.
Exactly. Closing proprietary trading is a massive structural decision. It sort of preempted the philosophy that would later be codified in the Volcker Rule.
Yeah.
For decades, proprietary trading was a huge driver of revenue and, let's be honest, compensation.
Sure.
By shutting it down, the firm was actively sacrificing that high-risk, high-reward revenue for stability. It was an institutional commitment to client service over speculation.
And a lot of that stability came largely through the strategic focus on wealth management, didn't it? They were aggressively building that into the industry's leading platform. Tell us about the importance of integrating the global wealth management group, particularly Morgan Stanley Smith Barney.
Yeah, the wealth management engine was really the strategic ballast of the entire post-crisis firm. The integration of Morgan Stanley Smith Barney was aimed squarely at securing attractive long-term margins.
Why? What makes wealth management so stable?
Because wealth management generates steady, fee-based revenues, and it increases client deposits and lending revenues, sources of capital that are inherently less volatile and, crucially, less capital-heavy than traditional investment banking or proprietary trading.
So the overarching goal shifted dramatically then. It wasn't about being the biggest or the riskiest anymore, but the most client-centric.
Precisely. The stated goal was to be the premier client-centered financial services firm, combining their deep institutional capabilities, like an M&A, with the stability of that leading individual wealth management platform. It was a massive strategic refocus on the client relationship, knowing that relationship generated recurring, predictable revenue streams.
Okay, that brings us to the results of 2010. If the pivot was towards stable, client-centered revenue and less proprietary risk, did their numbers actually prove that the strategy was already paying off?
They did, surprisingly quickly perhaps. 2010 was a strong financial rebound, proving the model was working even amidst all those regulatory headwinds.
What were the numbers?
The firm posted net revenues of $31.6 billion and net income from continuing operations of $4.5 billion, or 2.44 AS per share. These were the highest revenues and net income the firm had reported since 2006, before the crisis really hit hard.
That is remarkable performance given the headwinds. And even the book value per common share grew a robust 16% to $31.49. But it wasn't just volume, was it? It was execution and market dominance that year, too.
That's right. The execution power was impressive. They ranked #1 in M&A, global IPOs, and global equity. We saw execution power advising on 9 of the top 10 announced transactions of 2010. That's dominant.
And they pulled out specific, massive landmark deals to demonstrate that global execution power, didn't they?
Absolutely. Think about the scope. The GM and Citi offerings in the U.S., the Agricultural Bank of China in Asia, or that massive $70.1 billion Petrobras offering in Brazil.
Huge deals.
They were at the center of the world's largest transactions, demonstrating that even without proprietary trading, their institutional securities platform was still dominant.
And this success is what the letter referred to as the flywheel effect. Let's make sure we clearly understand that concept. How does that powerful internal ecosystem work?
Right, the flywheel effect.
Mm-hmm.
It basically describes the synergy within their new business structure. So imagine a huge M&A advisory deal. That's investment banking, right?
Yeah.
That deal immediately requires financing and capital raising, which drives activity into capital markets. That, in turn, generates equity and debt issuance, which feeds the trading desk, but the client trading desk. Sales and trading.
Got it.
And finally, the compensation and wealth generated by the executives involved in those deals. That often feeds right into the wealth management division.
So investment banking is the initial push that gets the entire mechanism spinning, driving client flow across the whole global franchise. It's an interconnected ecosystem where one success feeds the next, relying only on client activity, not firm speculation.
That's the strategic brilliance of it, or at least the plan. They expected this client-driven flywheel to become even more powerful as global markets continued to recover.
Okay, pivoting globally now. The firm noted its long history of international expansion since the 1960s. The letter mentions their critical relationship with Mitsubishi UFJ Financial Group, or MUFG in Japan. What strategic advantages did that relationship offer?
The relationship with MUFG Mitsubishi UFJ Financial Group, huge Japanese financial institution, was really key for global scale and local presence.
How so?
It allowed them to establish a global loan marketing joint venture and a securities business joint venture right there in Japan. This was important not just for capital, but for demonstrating global resilience.
And they mentioned the earthquake, right?
Yes. The letter makes a point of referencing the support they provided to their colleagues and partners in Japan following the tragic March earthquake and tsunami, showing their commitment extended beyond just pure business. It was a relationship.
Beyond Japan, the letter clearly staked out 3 dynamic emerging markets as absolutely critical growth pillars for the next 1 to 2 decades.
That's right. Those were China, India, and Brazil. They recognized that sustained long-term growth required massive diversification into markets that were projected to grow the fastest.
Let's look at China first. They had over 500 employees there and a partnership with the sovereign wealth fund, the China Investment Corporation. But they also made a major move in 2010 regarding a joint venture, didn't they?
They did. They sold their stake in their existing joint venture with China International Capital Corporation, or CICC.
Why so?
Well, The sale was strategic. It actually paved the way for them to start a brand new joint venture in China. This showed they were actively retooling their approach to better fit the regulatory and commercial landscape of the country, rather than just relying on legacy structures, always adapting.
Okay. And what about India and Brazil? Why those two markets specifically for that kind of long-term 10, 20-year growth horizon?
Both just offered massive, largely untapped potential for capital market development at the time. In India, they were already reinforcing their investment banking and institutional equities franchise.
And the proof was in the pudding, as they say.
It was. They ranked #1 in India M&A in 2010 and helped lead the $3.5 billion Coal India IPO, which at the time was the largest ever in the country. That is market-defining work.
Absolutely. And in Brazil, similar story.
Very similar. They were deepening the institutional securities platform. They had about 230 people in São Paulo already.
Mm-hmm.
Yes. Their capabilities there meant they were one of the 3 most active traders on the Brazilian stock market. And critically, they acted as global coordinator on that Petrobras landmark $70.1 billion equity offering, the world's largest equity offering ever at the time.
Wow.
Their presence was not just foundational, it was consequential across all 3 of these major growth economies.
Despite all this clear performance and strategic positioning, the outlook section of the letter was, well, pretty cautious, which is understandable given the geopolitical landscape of early 2011.
It's a very mixed picture, wasn't it? While they saw evidence of economic recovery, led by the U.S. with some modest improvements in unemployment, volatility was extremely high.
What were the main drivers of that volatility?
Well, you had the political transformation sweeping North Africa and the Middle East. The Arab Spring was unfolding. And then, coupled with the tragic events in Japan we just mentioned, all this pointed to a need for sustained strategic discipline.
And that discipline focused on what they called strategic imperatives, particularly capital efficiency. We've mentioned this concept of capital-light assets a few times. What was the mandate for the coming years, and why was capital-light so important?
The mandate was clear. Continue to build out businesses that require less balance sheet, meaning those capital-light businesses like wealth and asset management fees.
Why the focus on less balance sheet?
Because under the new Basel III rules being implemented globally, banks were required to hold significantly more capital against riskier, balance sheet-intensive assets like loans, and especially trading positions.
Got it. So by focusing on fees and client commissions, they were minimizing the amount of capital they had to lock up, essentially, making their capital more efficient.
Exactly. Generating higher returns on assets, or ROA. They needed to reallocate capital across the entire franchise and generate higher returns from the more capital-intensive businesses they did keep. The entire future depended on relentlessly disciplined execution of this efficiency strategy. Less risk, higher return on the capital they did deploy.
And finally, they wrapped the whole strategic discussion back to the people and the firm's, 75-year history at that point?
Yeah, they connected the 2011 strategic pivot right back to the firm's founding ethos, emphasizing that their defining characteristic was the quality of its 60,000 people across 42 nations, operating with honesty and integrity.
So the message was?
The core message seemed to be that the new structure, focusing on client stability and global discipline, would allow them to build on their tradition of excellence and deliver value in the new post-crisis reality. It was both a break from the immediate past and a return to core values in a way.
So this deep dive really gives you a remarkable look into the immediate fallout of the financial crisis. We saw how the necessity of global synchronized regulation led this institution to immediately internalize that discipline by killing proprietary risk and focusing intensely on the safest possible revenue stream, the client relationship, to drive that synergistic flywheel.
And if we connect this to the bigger picture, given the firm's plea back in 2011 that regulatory rulemaking must be done right rather than that it simply gets done quickly, you have to ask, right?
Yeah.
Consider this. Did the subsequent decade of implementing Dodd-Frank and Basel III ultimately deliver the market certainty and the safer, more secure financial sector they envisioned?
That's the big question.
What unintended consequences, if any, arose from that long, complex pursuit of getting it right?
Yeah, and to start exploring that answer, you probably need to look specifically at the history of the Volcker Rule implementation over the next few years. Did the regulation that finally codified the closure of proprietary trading groups actually yield the necessary intended results? Or did it simply shift the risk elsewhere in the financial system? That's the question we are left with.
A question for another day, perhaps.
Definitely something to think about. We'll see you next time for the next deep dive.